to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up in a moment, we have an exclusive interview with Brien Lundin, CEO of Jefferson Financial, editor of the Gold Newsletter, and the man behind the renowned New Orleans Investment Conference. With gold and silver prices reaching even higher highs this week, Mike Maharrey and Brien discuss the implications of this rapid rise, including the potential reordering of the global financial system and the decline of fiat currencies. They explore the concept of de-dollarization and the growing mainstream recognition of these trends. Brien also touches on the shift in portfolio recommendations, with a major financial advisor now suggesting a 60-20-20 portfolio breakdown, with a 20% allocation now being suggested to go into gold. This is seen as a significant shift from the traditional 60-40 stock bond portfolio that's been recommended for years. So be sure to stick around for a fascinating conversation with metals and financial industry insider Brien Lundin coming up after this week's market update. And as a reminder, please download, like, rate, and subscribe to this podcast, wherever you consume this content. Gold surged above $4,000 per ounce this week on massive buying and momentum. The yellow metal is now up over 50% in 2025, thanks to currency debasement, geopolitical tensions, sustained central bank buying, Fed rate cuts, and now a new shift on Wall Street with investment houses swapping bonds for gold. This latest surge reflects a broader reallocation away from overvalued equities and a search for monetary stability. Meanwhile, bullion-backed ETFs just saw their largest inflows in more than 3 years, reflecting growing retail and institutional participation. And U.S. retail sales volume at Money Metals Exchange has risen substantially in recent days. But the biggest story this week by far is what's happening with silver. Up roughly $2 for the week as of this Friday recording, the poor man's gold is trading over its all-time high of $50. In fact, silver traded well over $51 for a few hours on the London market, where physical silver supply appears particularly tight right now. Here's the backstory. The London market has been the epicenter of physical precious metals trading in the Western world. You may recall all the stories earlier this year reporting on the large amount of gold and silver getting moved from London over to U.S.-based depositories, trying to get ahead of potential U.S. import tariffs on gold and silver. Those tariffs never materialized, but huge amounts of metal was physically moved out of London. Subsequently, huge physical demand for silver started coming from the Middle East, India, and the rest of Asia, and that has been draining even more silver out of London over the past few months. Combine that with the big inflows into silver ETFs, funds that also happen to source their silver in the London market, and the available supply is getting very tight. At Money Metals, we've seen huge silver demand coming in, many of it coming from first-time customers. It seems the headlines are grabbing some attention out there. Circling back to gold, several Wall Street analysts have just increased their price forecast. Goldman Sachs bumped up its 2026 gold target to $4,900, citing demand driven by continued central bank buying and a surge of Western investment. The big investment bank previously called for a $4,300 gold price by the end of 26. In a research note, Goldman said that strong structural demand from central banks and easing from the U.S. Federal Reserve, as well as ETF demand, would continue to support the gold price. Goldman split gold investors into two groups. First, there are conviction buyers that tend to purchase the yellow metal consistently, regardless of the price, and based on their view of the economy or to hedge risk. On the other hand, there's also opportunistic buyers who move in and out of the market based on price, essentially providing a floor under prices on the way down and resistance on the way up. Goldman analysts also expect central banks to continue increasing their gold reserves and recommended that investors in general would be well served to diversify into gold. This dovetails with a recent seismic shift in investing advice by Morgan Stanley CIO Michael Wilson, who recently said investors should consider a 60-20-20 strategy, swapping half of the bond portfolio for gold to serve as a more resilient inflation hedge. If more mainstream advisors embrace this strategy, it could drive gold demand even higher, especially given so few Americans have any real amount of precious metals. Our podcast guest this week will expand on this during the upcoming interview. However, many investors worry that gold might be getting ahead of itself, raising concerns of a major correction. TD Securities head of market strategy, Bart Mellick, acknowledged this risk as he raised his price forecast to $4,400 by the second quarter of 2026. He called any price drops a buying opportunity. As for the specific weekly market action, before we get to the interview, gold is checking in at an even $4,000 as of this Friday midday recording. That's good for a $100 or 2.6% increase since last Friday's close. As for the wild silver market action, it currently results in a $50.45 spot price as of this moment, up more than $2 for the week or 4.7%. This marks the 8th consecutive week now that both gold and silver have been up. As for the PGMs, platinum is little changed to $1,611, while palladium is up a robust 11.5% to come in at $1,430. Well, now, without further delay, let's get right to our exclusive interview with the man behind the famous New Orleans investment conference, Brien Lundin.
Greetings, I'm Mike Meharry, an analyst and reporter here at Money Metals, and I'm thrilled to be joined today by Brien Lundin. He is the CEO of Jefferson Financial, the publisher of the Gold Newsletter, and the man behind the New Orleans Investment Conference. And let's be honest, an all-around great guy. How you doing?
I'm doing great, Mike. You are an all-around great guy. I'm a big fan of you and your content and the whole team there. So really appreciate the opportunity to be on, especially when we can talk about such fun matters as what's going on in the markets right now, at least from our perspective.
I know, it's pretty exciting. So we're talking today on Tuesday. This interview will actually air in a few days, but we actually had gold flirting with $4,000 an ounce today. I don't know if the spot price ever quite got over there, but I do know the futures price was above 4,000 when I looked at it earlier this morning. Are you surprised at how fast? I think we all kind of felt like 4,000 was in the sights, but are you surprised how fast we've gotten here?
Yeah, and we all kind of expected it was in the sights, but that depends on how long ago you were talking about. When we, a year ago, if we would have talked about these kinds of numbers, they would have firmly placed the tinfoil hat on our top of our heads. Much less when we were talking about all these numbers years and years ago. So it's been absolutely stunning. I think everybody's trying to catch their breath and say, what now? We're not used to being right, much less so right, and at least in this aspect of our lives. So, yeah, it is absolutely stunning. And I think it's more surprising for those of us who are in the market, how rapidly it's happened, even than those outside of the market, the generalists and the like, who are seeing it as just yet another market that's going up because of all this liquidity and all these oceans of liquidity sloshing around the world. But I think we are those gold bugs and silver bugs, and people have been in this market for so many years. We're looking at it with some real trepidation. We know that gold doesn't do something like this unless it's telling us something. And right now it's not whispering, it's screaming that something's up.
Yeah, it's funny. You actually kind of touched on something that I was going to ask you, because I know for me, I almost feel like a whipped puppy. It's like this is great, but please don't hit me. It almost feels like
before to come upside your head.
Yeah.
Out of the blue.
But I mean, why do you think that is? Why are we so like? I don't know even how to put it. It's almost like we're scared by the success and that things are actually playing out how we thought they were going to play out. Why do you think?
It's exactly why a whip puppy, cringes when a hand is raised, because we've gotten beaten back by the powers that be so many times. And it's amazing for us and somewhat unbelievable at our core to see that the powers that be try to play the games that they did for many years, and then they just get bulldozed over by the market. I mean, it's wonderful to see, but it is a bit scary, to be so right. And, a part of it is be careful what you ask for, because you might just get it. And, what does this mean? It reminds me, and I posted this on X today or yesterday, and I didn't give credit to it, but it was a conversation I had over email with Jim Grant really a few years ago. And Jim is the ultimate gold bug, as you know, and he signed off his email to me, here's the $25,000 gold. And I replied to him and said, Jim, when gold gets to $25,000, we'll be lighting our cigars with $100 bills with our AR-15s draped across our laps. And that's the truth. Be careful what you ask for in that kind of an environment. And I got a lot of some pushback on X over the last day on that. People saying, "Oh, it won't be that bad," just long time coming. We always knew it was going to happen, and it's not going to be Mad Max. And my reply is nobody knows. Nobody knows what it's going to be like. All you can do is recognize the trend and be glad that you're owning gold going into it. So, I think that's kind of where we are. It is a bit scary, though, to see this kind of a run.
Yeah. You said that this run of gold and silver both are kind of screaming something. What is it screaming? I mean, what people out there who might not, maybe they've got their headphones on and they're grooving to some music or something. What is this market telling us right now?
Well, I think it's saying that there's going to be a reordering of the financial sphere, the system. And I'm not a big believer that the dollar is going to lose its dominance in its global reserve currency status anytime soon, for a number of reasons. But I also don't believe it's the U.S. itself or the dollar itself. I think it's all fiat currencies. And when you have 45 years since basically 1980 of ever lowering interest rates, ever easier money, and ever greater debt accumulation as a result, is going to come a reckoning. And, we're in the end game. We don't know how long it's going to last, but I think there's a recognition out there that this is coming to an end, and we see where the trend is going. Obviously, this bull market has been driven largely by central bank buying, but this latest surge really, there's been a couple of times. There was a big surge in April of this year where we gained almost $500 in about 2.5 weeks. And similarly, over the last month or so, when we've done about the same. What happened? What was driving that? I don't think it's been all central bank buying, or at least not all the central banks we see. And most people say, well, yeah, China's probably in there buying. That's what we're not seeing. Right. I think it might be the U.S. in there buying. And that's something I've been talking about a good bit lately. And I posted a chart that showed all the talk. I actually plotted the X posts mentions about a Fort Knox gold audit. And they peaked in February, and then radio silence. And from roughly that point on, the gold price took off. And is that, probably just a coincidence, but that would explain a lot if all of a sudden, they said, stop talking about an audit of Fort Knox. We've got to get some gold in there before we start auditing it, because that would really shake things up if we audited it and there was no gold there, or some of it was missing. So I've long believed that this central bank buying, a good part of it is gold going back to where it should have been all along, and not just additions to reserves. So, yeah, I don't know what the question was originally.
No, that was great. A couple of things popped into my head. You talked about this ordering of the of the financial system, and you and I are definitely on the same page. I've never been one to say, "Oh, we're going to have this," overnight collapse of the dollar where we wake up one day and all of a sudden, oh no, the dollar's not the reserve currency anymore. To me, it seems more like this kind of a slow bleed, a death by 1,000 cuts, as the saying goes. But what's kind of interesting is that the mainstream has definitely taken notice. You see the term de-dollarization in the mainstream financial media, maybe not as much as, as we would see it in our circles, but it's definitely out there. And it's interesting to me because, I go back, started talking about this kind of the threat of de-dollarization back in 2017, 2018, and people all, it was the tinfoil hat thing. Oh, yeah. Mike Maharrey is crazy. And now it's like, it's in this kind of mainstream talk. And I've said for a long time, it doesn't require a complete meltdown of the dollar to cause a great deal of trouble for the United States, because we depend on this dollar dominance to basically support the borrowing and spending machine. And I think that the world is kind of looking sideways at us and saying, we're not really interested in supporting this anymore. Do you get that sense as well?
Yeah, to some degree. You recognize the trend, and just because you see the trend doesn't mean you have a good handle on when it'll end. But I think you have to define your terms, and I think a lot of people use these terms interchangeably when they couldn't be more different. And, it happened on CNBC this morning. They were talking about gold. And somebody said, yeah, the dollar index is really hitting a key support line, so that's probably got a big part in it. And it doesn't. It's totally irrelevant. The dollar milkshake theory, Brent's a good friend of mine. It's irrelevant to the price of gold. It matters in a whole lot of different areas. But the dollar index is the dollar measured against all the other trash out there.
Right.
It's the best looking leper in the colony.
Yeah.
So it doesn't really, for traders and everything else, has a lot of influence and a lot of relevance. But if you look at what is a true measure of the dollar's worth, it has collapsed because it's collapsed against gold. And if you look at the dollar index's correlation to gold, which everybody thinks is so close as an inverse correlation, it really isn't over long sweeps of time. Gold does what it's going to do, and it does that because the dollar and other fiat currencies are losing their purchasing power. And it's as simple as that. So the dollar index is not, it may be an indication of the dollar losing its status among other fiat currencies and its reserve currency status. But the real indication of the dollar losing its reserve currency status is the makeup of central bank reserves. And by some measures, Tabby's now famous chart, gold's already surpassed the dollar in terms of U.S. Treasuries. If you look at Jan's charts, we still have a little ways to go. I don't know what the difference is there, but the trend is clear. Mm-hmm. Gold is now becoming the dominant central bank reserve holding.
That's a really good point, and I think I've probably been guilty of that as well. But it is a reflection of not just the dollar, but this entire fiat construct that's breaking down and failing. And I think that's a really important thing to remember. As you were saying that, it occurred to me, I just saw today that silver is at an all-time high in rupee terms. So there's another fiat currency that you can measure silver against. So,
and that probably has a good bit to do with an unrespected bit of knowledge is that silver is one of the great. India is one of the great silver sinks of the world. Mm-hmm. We put out a report in our first silver bonanza report in 1993 that detailed that surprising statistic. Nobody really understood it. India is known for gold, but if the rupee is losing value against silver, that's the reason why people are buying silver, and silver demand in India has spiked recently.
Yeah, we saw that. So I wanted to touch on what Morgan Stanley CIO Michael Wilson said the other day. I'm sure you've heard about this. He actually kind of broke with the conventional wisdom. It's always been the 60-40 portfolio, 60% equities, 40% fixed assets, so bonds basically. And he said that we need to start thinking about a 60-20-20 portfolio balancing with 20% going to gold. I thought this was really significant coming from, a mainstream American financial advisor. Did that strike you the same way that it did me?
Well, I guess so. That is coming from a mainstream advisor, but it's simple math. If you go back over history, and God knows I've been actually looking at this specific question over 30 years now, and that is, what is the optimum portfolio makeup for optimum risk-adjusted return, the so-called efficient frontier of risk-adjusted return that modern portfolio theory would designate. And years ago, early 90s, I was looking at it when we were putting out one of the first hedge funds, really. And back then, it was found that using all of the higher level math, et cetera, that if you had 5% allocated to gold, and keep in mind, this is after a decade of underperformance by gold. If you had 5% allocated to gold, it improved your risk-adjusted return. It was kind of a moderator, contracyclical, et cetera. Well, all of these calculations are done by back testing a decade or more. And over the last 25 years, gold has actually outperformed every other asset class. And if you look at that, then the numbers, modern portfolio theory is just going to say, well, you've got to up your percentage to gold to get a better return, except in this case, is trying to get a better return and not moderate risk. Because the risk part is the crazy thing that's happened, and that's all. Gets into all this passive portfolio management problems and issues. But everything has been lifted on a sea of liquidity. So these correlations that used to be inverse have gone positive and largely positive. They've all trended toward one: stocks, bonds, commodities, precious metals, monetary metals. They've all been lifted on a sea of liquidity that has been gushed forth by the Fed and other central banks. So it's really made a mess of all of those analyses. So I'm not surprised that gold has shown to provide higher returns with a higher mix. But it's interesting how the risk-adjusted return may have fluctuated over these decades when everything's been driven through financial repression and central bank liquidity provisions.
Yeah. I was talking to Stefan Gleason. For folks who don't know, he's the boss here at Money Metals. Yeah, that dude. And we were talking about this, and he brought up the point that you could almost say that the modern financial advisor network, the conventional wisdom, it's almost been fiduciary malpractice to basically steer people away from gold for so long. Why do you think that? I mean, why do you think that is? And maybe are we seeing a shift where it's just too hard to ignore now?
Probably trailing commissions in lack thereof.
That was my thought too.
There's just no money in it for them. There's also been a concerted effort to label that kind of thinking with, the tinfoil hat kind of a thinking as gold bugs. And believe me, you as well are very familiar with it, that we've always been doom and gloomers, et cetera, et cetera. And I appreciate that probably more than any other human on the planet, because I've seen really smart people grace the stage of my conference over many, many years and predict the coming collapse of Western civilization, et cetera, et cetera. And all of a sudden, I'm starting to think, maybe this is the time, because the numbers are actually getting so compelling. And when you see mainstream people, you look on CNBC now, and some of the renowned as being the smartest people on Wall Street, in the investment industry are saying the same thing that we've been saying for decades. It really does seem like it's finally coming to a head here.
Yeah, I think a lot of people don't understand, and I'm definitely, I'll confess to being a doom and gloomer in a lot of ways, but I think a lot of it is kind of I don't know, for me, I tend to step way back, and I'm looking at things in like this kind of big macro picture with this kind of Austrian economics understanding. And I've tried really hard not to try to say, okay, in 10 years we're going to have this, or but just the system as it is unsustainable, and it's been unsustainable for a long time. And I think that's kind of why folks like you and I kind of have this worldview, whereas people that are just looking at yesterday's data or whatever might have a kind of a different picture of what's going on. It's maybe a little bit of a longer view. You think that's a fair assessment?
Yeah, absolutely. Yeah. And again, we recognize and have recognized a trend for a long time. It's easy to spot a trend. It's not always easy to spot its end. And so we don't know when, suddenly something that hasn't mattered matters. And, we know as well here in New Orleans, that complacency kills. So, we saw those levees being, going into disuse and never worried about it because nothing happened. And all of a sudden it matters. And I think we're kind of in that spot.
Yeah.
Now, Paul Tudor Jones is one of the smartest guys out there. And he was essentially preaching a financial apocalypse yesterday on CNBC. And everybody kind of hums, oh, that's interesting. And moves on, how am I going to make my money today? And
yeah.
Kind of a thing.
Yeah, it's kind of, it doesn't matter until it does.
Yeah.
Right? What's that saying? Things happen slowly and then all at once.
Yeah, that's exactly right.
Okay, I'm going to shift gears a little bit here. I came across an interesting data point the other day, and I actually wrote an article about it. Gold miners as a whole, if you're looking at this specific index of gold miners, have outperformed AI chip makers so far this year, which I thought was interesting because everybody's all AI. And I know the miners kind of lagged early in the bull market, and there was a lot of complaints about it from some folks. What's wrong with the gold miners? We've got this huge run up in the price of gold, and the gold miners are lagging. Now, they seem to be catching up now. But I'm curious if you can maybe step back and give a little bit of an overview of the relationship between moves in a bull market for physical metal and the mining stocks, and how those two kind of interplay, maybe from a historical perspective.
Yeah, a lot to unpack there. Everybody keeps talking about how gold moves and the miners move afterwards, but that isn't actually the historical fact. It used to be, the truism used to be that the miners predicted a move in gold and they led gold. Regardless, right, this bull market is unique in the history of gold as an investable asset, which goes way back to 1974. But this bull market is unique because this is the first one where the miners and silver have lagged gold to such an extent because central banks don't buy miners and silver. And they have moved. They finally moved because the Western investors who have typically sparked these kinds of bull markets in the past all of a sudden tried to get in, and they saw that the price of admission to the party was so high with gold having moved, so they're entering through the individual, through miners and through silver, and so we're in a catch-up phase. So the miners, the large miners, the big producers have doubled or even tripled, yet measured on price to earnings, measured on price to NAV, price to book, all these historic standard metrics, they're still at the low end of their historic ranges because their earnings have increased more rapidly than their prices have. So they're still long-term undervalued. The juniors, you can go into, you look at those in a lot of different metrics, but they're still undervalued. And they've doubled or tripled, most of them, or a good many of them, over the last 6 weeks, 8 weeks, something like that. So we've seen huge moves, and people are stunned and starting to talk about taking profits, which is always a good idea. You should always consider taking money off the table. But I think that the sector, the equities, seem so overbought right now, not so much because they are at the peak of a move, but because they were so undervalued before. We were looking at junior explorers with under $5 million market caps a year ago or 6 months ago. And now those companies are trading for $25, $30 million market caps, historically kind of normal. We were looking at companies with big resources that were trading at less than $10 an ounce in the ground, and now they're at $30 to $40 an ounce in the ground, which is still, on a long-term basis, when these deposits sell for $150 an ounce in the ground, really undervalued. So they were just beaten up and forgotten for so long, and I think that really taints our view on where they are now. They've come a long way, but they're still historically undervalued. Again, all this said, there's been a lot of profits made in the sector, and people should always look at taking something off the table.
Yeah. So the early part of this gold bull run, we had kind of a lot of American investors in particular sitting on the sidelines. We saw it really pronounced in the physical market, where really selling was outpacing buying. I think we're starting to see more American and Western interest in gold. We're particularly seeing that in this big surge of metal into the ETFs. But, looking at $4,000 gold, that's a big number. You've got all these people sitting on the sidelines. Are they too late to the party? What would you tell somebody who's like, oh my gosh, am I missing out here? How do you kind of look at the way the average investor here in America should be thinking right now?
Yeah, and I get back to what I always say: 2 reasons to own gold, to hold gold. One is insurance, one is investment. If you're looking at it as an investment, you probably should stay out because it's moved so far, and look to the more undervalued leverages on gold, silver and mining stocks in a way, as a way to participate in the investment case. If you're looking at it from the insurance standpoint, I think the question is not whether you can afford to buy gold at these prices, but whether you can afford not to, because every dollar you put into gold is going to most likely, nobody knows the future, but most likely retain its purchasing power over the next whenever, 3 years, 5 years, 10 years, 20 years. That same dollar, if left in the bank as cash, is likely to lose at an accelerating rate purchasing power over the next few years and going much further forward. So you are protecting wealth, you're protecting purchasing power by putting it into gold. That's been a lesson of history over a long period of time. So, it's a great savings tool. It's a way to save money and protect yourself and insulate yourself. And that's one of the things the mainstream is talking about now, is that people are regarding gold. They even mentioned that on CNBC this morning. People are regarding gold as being more reliable than a dollar. Well, duh. I mean, right. So it's only taken you 40, 50, 60 years to come to that conclusion. Okay, but at least you're thinking about it now.
Yeah, thank you. All right, so we're getting close to the New Orleans Investment Conference. Tell us what's on tap and why should folks that are listening consider going?
Well, there's one truism, one thing that's rung true over 5 decades of investing history, and that is, in a metals and mining bull market, you need to be in New Orleans. You need to be at this event. It's the best place to get the best advice. We've got the smartest, to my mind, because I picked them all out for their intelligence and their well-reasoned arguments. They are the best analysts and commentators and strategic thinkers in macroeconomics, metals, miners, geopolitics that you'll find anywhere. I tell people that you could find 2, 3, maybe 4 of our speakers at any other conference, but you're not going to find 40. And that's just what we have. So this is by far the best lineup of speakers. It's the best place to find other investors who are in the sector, who are independent-minded, who are very successful and have ideas to share. That's a huge value. And our exhibit hall is packed with most of at least tomorrow's and next year's biggest winners in the mining sector. Every year, many of, if not most of, the biggest winners of the next year are found in our exhibit hall. And that's what's going to happen this year again. It's teeming. We're selling out right and left on booths in the exhibit hall. We've got our speaker lineup. I urge people to go to NewOrleansConference.com and look at our speaker roster. It is the best you'll find. I think it's our best in many years even. And it's kind of the place to be. I would encourage people not to wait, though, because availability in our host hotel is tightening very quickly, and this is going to be one of the biggest years we've seen in decades, and it's going to be packed with opportunity. You don't want to miss it if you're in this sector.
Yeah, and it's right around the corner, November 2nd through 5th. Did I say that right? 2nd through the 5th? Yeah, that makes sense.
Coming right up.
Yeah, very exciting. And of course, you get to go to New Orleans. Who doesn't want to go to New Orleans?
Yeah, it's kind of fun. Yeah.
Great, good food and good music, man.
It is, and we bring a good bit of that into the conference. We have great food. We have great social events. We have James Rivers closing out the conference again. He's 86 or 87. I think he is one of the icons of New Orleans music. He won't be doing this much longer. Really something to see.
Yeah. So where can folks, first off, let folks know where they can find out about the conference and where they can get tickets and all that information. And then let folks know where they can follow you and avail themselves of your wealth of knowledge and commentary that you're throwing out there.
Yeah, well, New Orleans Conference is a great place to do all of that. It's NewOrleansConference.com, very simply. People can follow me on the X at Brien_Lundin. Weird spelling on both of those, so look it up. And goldnewsletter.com is where you can get my weekly and or monthly advice and a free report on how to invest in metals and mining. But November 2nd to 5th, it's coming up quickly. This is going to be our biggest year in many, and it's going to be an awful lot of fun and an awful lot of opportunity that you don't want to miss.
Well, Brien, I'm really happy that you spent a little bit of time with me today. I very much appreciate your insights and your wisdom, and it's always a pleasure to talk to you. And we'll definitely get you back on here again for sure. It's going to be interesting to see, $4,000. Well, then what? Right? That's just maybe just another milepost in what's been a pretty interesting race. So thanks again. And really appreciate all that you do and glad there's a Brien Lundin in the world.
Thank you so much, Michael. It's a great pleasure as always. And look forward to talking to you in the future. We've been scarily right so far. Let's hope we continue to be. And thanks for the opportunity.
Yeah. Have a good one.
Brien is a wonderful guest, and we thoroughly enjoyed having him back on, and we hope folks will plan to attend the New Orleans Investment Conference coming up in just a few weeks. For information there, go to NewOrleansConference.com. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. And don't miss our second weekly podcast, the Money Metals Midweek Memo, available each Wednesday. To check out any of our audio programs, just visit moneymetals.com/podcast. Or find them on places like Spotify, Apple Podcasts, Google Podcasts, and other popular podcast platforms. And as a big help to us, we would ask that you please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.